Welcome to the Juggling Mind and Money podcast with Steve Rowe and Jessica Schlupp-Taylor. Steve Rowe is the founder of Lucent Financial Planning and an award-winning independent financial planner. He helps you to use your money and have a great life. Jess Schlupp-Taylor is a psychologist supporting people through change, challenges, and forks in the road of life. Together, they will help unblock the sludge in your mind, stopping you from achieving financial and psychological happiness.
Hello and welcome to episode 31 of Juggling Mind and Money. I'm Steve Rowe, founder of Lucent Financial Planning and a chartered financial planner. Normally, Jess is here to keep our heads healthy, but today it's just me and a very special guest, Laurentius van den Verm. I said that right, Laurentius? Of course I haven't.
You've said it as correct as you could be, Stephen.
Well, introduce yourself, Laurentius.
No, great. Nice being here, Stephen. So yeah, I'm Laurentius van den Verm. I'm head of investment strategy at Timeline Portfolios.
Boom. That's it. Okay. So, tell us, Laurentius, what is head of investment strategy? Do you actually do anything from day to day?
It feels like you've had a conversation with the same journalist that asked me the very same question a couple of years ago. At the time, I was just investment strategist at Timeline, and came to me and he was like, Laurentius, so tell me, a relatively passive house that doesn't do a lot of portfolio changes, what are you doing as an investment strategist? And my only comeback at the moment was I told him, listen, Robin, my job is just to avoid stupidity. and it's still my go-to answer if somebody asks me, what are you doing as head of investment strategist? And there are so many investment strategists and analysts in the market just trying to figure out new stuff to sell to their clients or their investors. My role is literally to look through all of that, understand what people are doing, and ultimately keep the portfolios in the best possible shape, keep the integrity of the portfolios high, and avoid stupidity.
Awesome. So you've obviously failed there in one sense because you're trying to avoid stupidity and appearing on this podcast with me.
You got me there.
Okay, so Timelines are one of the companies we use to invest our clients' money. So we're going to look at that today. We're going to look at a few things like why Laurentius has small cap and value factors underperformed for such a long period of time. Why have US large capitalized companies stormed ahead so much? What's been going on there? Should UK investors worry about UK currency swings? So we'll have a look at those different things today. But firstly, we do need to say that Laurentius, this is probably the last podcast or appearance you'll ever make because you are going skiing soon, aren't you?
Are you saying that I might not ever come back, Stephen? But yes, it is going to be my first skiing trip.
We were just discussing off air, everyone, how we're both 18 stone and how I went skiing a couple of years ago for the first time and it ruined me. I'm barely recovered now. So, Laurentius, tell me, obviously this is why we use Timelines, help us with investments. This is our and my investment philosophy. But what is Timelines' investment philosophy? Is it yours? Was it yours before you worked for them, Laurentius? Or are you a turncoat? Explain all about that and how any investments work.
It's a very good question. I'll break it up in two parts. Let's start with, was it mine before I joined Timeline? Because I think honesty is quite important here. So before I joined Timeline, I was actually a financial planner in South Africa, working for as an investment analyst for a wealth management firm. And I have to say it was a highly active wealth management firm. The portfolios that I was involved with were started out quite on the active side. One reason for that is in South Africa, you can't be fully globally passive because you have to invest 70% of your money within equities, not allowed to go more than 70% equities, and then you're not allowed to go more than 30% offshore. These days, I think you can go 40% offshore. So you have to imagine you have to invest all your clients' money in the UK, at least 70% of all the money in the UK. The UK is a very big market. If you are stuck in South Africa, it becomes quite a challenge to find those good companies. And for that reason, most active managers in South Africa, I don't want to say they outperform. They do better than the other active managers, let's say in the UK or in America, because there's a lot of junk that you have to go through in an emerging market. So no, the timeline strategy wasn't my investment philosophy when I joined the company first. We have introduced a lot of passive instruments. Factor investing is not a thing in South Africa, so funds that just strategically tilts to cheaper and smaller companies. That was not something that was available to us in South Africa. But index funds, yes, we've used them as much as we could. And then joining Timeline, that was actually something that I really liked doing. And then going into the whole factor space, that was something new, but I was familiar with the concept of it.
So Timeline's investment philosophy is essentially invest globally all around the world. Don't favour where you live just because you live there. Do it as cheaply as possible. Be as diversified as possible, but have more money in smaller companies and what are termed value companies than the proportion of the average global market. So if you could explain to us, Laurentius, what a value company is.
Yeah, I'm gonna do it in a very, very simple way, Stephen.
Well, you found stupid today, so that's what we want.
Let's use a property, because I think that's probably the asset that most people are familiar with. If you want
like a house,
if you want to buy a house,
yeah,
and you go out, your budget is £600,000. Let's say that's more or less what you pay in London these days for a 2-bedroom flat. Are you going to buy the smallest 2-bedroom flat for £600,000, or one for £600,000 right next door that are in a much better condition? Or let's say you've got both looking exactly the same, 2 mirror flats in the same block. One is at £50,000 cheaper than the other one. Which one are you going to buy? You're going to buy the cheaper flat, the one that is perceived to be on a discount. And that's exactly what a value security is. You look at what the intrinsic value of a stock should be, or what the average valuations of securities in the market is, and just overweight those that are on a discount.
So when you mean overweight, just put a bit more money in there.
Put a bit more money in there. So usually you would divide the market. You can sort of think of the market as 2 categories. You've got growth stocks, overpriced ones, and value stocks, underpriced ones, and split the market 50-50. Let's say you've got 50% growth stocks, the other half is undervalued. A stock must either be overvalued or undervalued. It can't be exactly fair valuation. And you just say, well, let's make that 50% value stocks in the market. Let's bump it up to 60% or 70% or whatever the number is. So just overweight those cheaper companies and underweight the more expensive ones.
Okay, so just put more money in them. Unlike us going skiing, where we're just overweight and too quick.
Exactly.
Because that's dangerous.
That is dangerous.
So that's one factor of investing where there might be a higher return. The other is smaller companies. Why? What's the reason for investing more in them?
So smaller companies has very much the exact same argument, and there's more reasons to why smaller companies than value companies. Value companies, based on the principle something that's undervalued should mean revert, something that's overvalued should mean revert. They must go to fair valuation. Small cap companies, in its most basic form, the company doesn't have an upside ceiling yet. They still have a lot of room to grow. They still have a lot of flexibility to grow. Less bound by regulations. There's much more movement, much more markets they can expand to. They are not mature companies yet, but they are also more risky. We've all seen the movie The Wolf of Wall Street, how risky penny stocks can be. I'm not saying go into penny stocks. We definitely don't go into penny stocks. We do small cap stocks, which is much larger than penny stocks. But ultimately, if an investor is willing to invest in those smaller companies that are more risky, they do require a higher return. So what we are saying is, let's make the portfolio slightly more risky. You should expect to be compensated for that risk.
And what other, so those are the main factors that we concentrate on, aren't they? But what other factors might there be? Because there's hundreds.
Those are the main factors. There are literally hundreds just within equities. There's another factor that we do concentrate on a lot, of which I am a huge fan. That's profitability. It's not something that's easily measurable, but what we are saying is companies that are more profitable should outperform companies that are less profitable. It's not rocket science. It took us until 2011, I believe, for Robert Novi Marx to statistically discover that it is actually a thing. Companies that are more profitable outperforms companies that are less profitable. But it statistically took us a very long time to discover that and actually determine how to look at profitability. And I'm not going to go into detail of how you should look at it. But ultimately, what we are saying is if you are investing in value stocks and small cap stocks, a company can be cheap and small for a reason. It's dying a slow death. But what if those companies are still profitable? Then you are mitigating the risk of those companies being in a what we would call a value trap or a size trap. So what we do in our portfolios, we tilt to those smaller value companies, but make sure we are tilting to those that are profitable. Those are the three factors we emphasize. We think it's your three common sense factors. It's the ones that will always work because it's based on logical reasoning. But then you've got other factors like momentum, dividend yield, volatility. There are so
I'd like
many.
to talk about momentum, if that's all right, Laurentius.
Okay. So
Because
momentum is actually a factor that is statistically very, very, very robust. And I don't have a lot of negative things to say about momentum. What momentum says is, in its simplest form, a stock that has done over the last, call it 12 months, will continue to have some momentum behind it and do well in the near future.
now,
And a
is
stock,
that because? So I think that's because people think, "Oh, that's gone up."
yeah, yeah, and it
So
is,
I'll buy it because of that, and then the weight of that extra money because that's gone up money
yeah.
forces the price up
So
further.
that is something that's well documented. The herding effect. It's a behavioral bias. It's also people can attribute a liquidity provision or liquidity in the market causing stocks to go up, sentiment. There are a lot of reasons for that. But the thing about momentum is there are very specific ways to measure it. And on paper, you can build a great momentum portfolio that does really, really well. But ultimately, paper is not the real world. You have to be able to trade those securities, get in, get out, and all those get in, get out costs money, keeps you out of the market for a long time if you're dealing with funds and platforms, and it's just not as practical as one would like it to be.
Yeah, so it's hard, and there is potentially big downsides, isn't
Oh,
there? Because
massive,
it's not a
massive.
fun. It's because it's a bias orientated
There's a
or
well-known saying in the investment industry that says momentum is your friend until it's no more. So it stops all of a sudden, and then it turns against you. So it is extremely high risk.
very much like the 18 stone skier, Laurentius. So I'm only bringing this up because it
I
happened to me, and you're about to. But it's good at first because you gather up pace quickly, and then it's frightening.
Yeah, I told my wife after our first ski lesson, it reminds me of, was it Newton's law, or whose law was it that says
Yeah.
momentum equals mass times velocity, and 18 stones is not in your favor on a ski slope, I guess, but I'll guess I'll find out in a week's time.
Interestingly, Isaac Newton, I think he's got the highest IQ in history, they reckon. Um, and he had a great investment quote because he made loads of money in the South Sea bubble, um,
Yeah.
sold out. He got FOMO, as they call it now. He jumped back in and lost loads. And he said, I can predict the movement of the Earth, the moon, and stars, and all this, but I have no idea about stock market returns or something.
Exactly.
That was
Exactly.
a good quote. Just thought I'd slip that in
And
and
it's still
interrupt
true.
you. Yeah, no one can do it.
Mm.
If you think you can, you can't.
Yeah.
That's my special voice there. So the US, it's this magnificent seven, which obviously I always just think of Yul Brynner and things, but they talk about these seven massive companies that have made so much money, the Nvidias, Googles, Amazons, things like that. They've gone up loads, haven't they, recently? What is the reason for that, Laurentius? And is it something we should be excited about or scared about? What should we do, if anything?
Well, I'm going to give a very political answer to that and not take any side whether it's good or bad or should you be excited or scared about it, because I think it's both. These 7 companies, to put it in perspective for you, so if you're talking about these 7 companies, the largest ones would be Nvidia, Google, Amazon, Apple, Microsoft, and then Tesla's in it, but Tesla's not really in the top 7 anymore. You've got Broadcom now, and then Facebook also. So those are your top players in the market. And if you take those 7 companies, they are in equity size, or in capitalization, or the size of those companies are larger than the 5 equity markets outside of the US. So take the UK, Canada, France, Germany, and I believe in Japan. Japan is the second largest equity market. 7 companies are larger than these 5 countries in
That is
combined.
nuts, isn't it?
It's nuts. It's nuts. So, yes, there is a concentration if you just buy a globally diversified index, because you have to buy these companies. I always tell people one of the biggest risks would be not to buy these companies, because these companies have driven global equity returns for the last couple of years. It's not as if they've just become massive all of a sudden and haven't contributed to our portfolios. They are at the size they are because they've contributed the most to our portfolios. Not investing in them is the biggest risk. So I would avoid that. Overweighting them, I think that might be a fool's game. You would naturally in a value portfolio underweight them because they tend to be overpriced, and they are overpriced because it is somewhat irrational, their current pricings. People don't know how to value these companies. It's a new industry, especially the last 2 years, this AI developments. How do you value an AI company? Nobody knows. So they are slightly overvalued.
Not even AI knows.
Not even AI knows. But what I can say to sort of comfort people, that because you get both people on both sides of the aisle. They don't want to be underweight these companies, or they do want to be underweight these companies. What I can say is, if you have a value strategy, you will naturally be underweight these companies most of the time. But then we've seen Apple, for example, have massive earnings boost, and that makes it a value company. If the earnings goes up and the price sort of doesn't keep pace with the earnings, we've seen that a few times especially with Apple and Facebook. It becomes a value company, we overweight them, become a growth company again, we sell a bit, cash in a bit of our profit. So it's a rules-based way to sort of capture some of these to and throws in these companies as well.
That's very important, isn't it? Having rules rather than banking your actions based on your feelings, because your feelings are probably going to be wrong.
Absolutely. And the rules-based is built in throughout the whole investment process. If you think about not just only what type of companies you want to invest in, value, size, those rules-based principles are extremely important, but then also the index funds that we invest in. What companies are in the index? Who decides that? A great example that I always use is Russia. 2022 February, when Russia started to build up its forces on the border of Ukraine. We had a lot of clients reached out to us. I think it was the 24th of February, when Russia actually invaded, asking us how much exposure do we have to Russia. We don't want any exposure. I reached out to our underlying fund managers, asked them the question. They said none. There was an ad hoc rebalance when Russia started to build up their forces. Liquidity have dried up for Russian equities. There's a rule that say you need to sort of have a certain level of liquidity in order to be within this index. The index providers have taken Russian equities out of your portfolios even before the invasion. And it shows you the power of having a solid rules-based process.
A rule rather than a feeling.
Yeah.
Okay, so I've been reading recently, and a couple of clients have been asking questions to us about with this Magnificent Seven, how the rise of passive investments in the last sort of 20 years, I guess. So more and more people, is it 50% now, 40 or 50% of investments are passively based, where you're just buying the index. I've been reading articles about how that might be affecting, say, the Magnificent Seven, where money is automatically buying those shares in those companies, and it isn't necessarily looking at the fundamentals, like what they actually earn. So the price is going up because it's going up, kind of automatically. Is that a good or a bad thing?
Well, okay, so that is one of the arguments that people make, is they say you need to have active managers, because active managers are your true price discoverers. and all these passive guys are just buying, and they are just driving up prices. But ultimately, Stephen, what I can say is, if that's true, first of all, active managers will then start to outperform again, because that will make markets inefficient. We haven't seen that happening. But I think the ultimate question is, I'm going to bring it back to a very simple example again. If I've got a room full of people and I ask them, how much is this pen worth? Or if I tell them this pen is worth $1,000, and they are price takers, meaning they are just passive investors, they have to buy my pen for $1,000. Surely someone in the room is going to say, no, this pen it's got a nice timeline branding on it, but it's not worth $1,000. I can probably get it somewhere for $5. They're going to buy it for $5 and distribute it for $10 and make a lot of profit. So you need a handful of good analysts to actually know what the price of a stock is. You don't need half of the market. And that's the argument that I have against this. We should, can probably start the discussion about market efficiency once we see these active managers outperform. And two, then we should look at the analysts and the guys actually buying the stocks. Are they getting it right constantly? Because I don't think you need a lot of people to tell me what a price of a company should be.
You know, with active managers, so they're trying to pick which companies might do the best in the future. So I just don't get it, because it's the future, and you might pick an active manager, but how do you know they're going to be any good, and they're going to be, they've got the qualifications or ability to do it? So you can do all the analysis that you want, can't you? But it's always backward looking, because it isn't written down unless it's already happened. And it doesn't mean that the person doing it has any special ability to do it anyway.
Yeah, and I guess it goes one way further. I always find it fascinating when people talk about a brilliant active manager. And don't get me wrong, there are some that have proven to be able to get it right. But they always talk about this brilliant active manager, and then they refer to the fund. If you're investing in an active manager and you agree that there are superior skills within this fund that you invest, that superior skills sits with the portfolio manager making the decisions. And you are technically investing or your trust in that portfolio manager. You've got no guarantee that he will be there next year. You've got no guarantee that his success isn't just luck over the last couple of years. We know your best investment managers do tend to get hijacked by your institutional managers. Most retail investors can't access institutional managers. So there are just so many risks out there, and getting it right, we know based on statistical research, you've got about a 10% of the shot of picking the right active manager that will outperform the market, because that's over 5 year and longer. That's more or less where the stats sit. 10% of active managers outperform the market. 90% just doesn't.
And it's hard picking that 1 in 10, isn't it? And they don't do it consistently, do they? So you might have one that's done it the last 5 years or something.
Well, even your good ones don't do it consistently. Take Warren Buffett, for example. He had periods where he went through a massive down cycle, and that's the same way with. And I have to say, Warren Buffett for me is one of those role models in the industry, because I think, yes, he was an active manager, and yes, his returns has been phenomenal, but he had the discipline to stick to his game, and I think he was the guy that understood factor investing, what we are doing, buying value, smaller, cheaper companies that's profitable, long before the academic industry actually caught up with it and gave it a term. Warren Buffett, we know he invests in companies that are mature, profit-generating companies. He also likes those smaller startup companies. BYD was one of the big examples that he backed and then got out of. And then also, he likes a high-quality, good-earning company. So, and then he backs those companies for a very long period of time. He's not a speculator. So yes, those are the active managers that you need to back, but good luck trying to find them and keeping them.
I think with Warren Buffett, it's a bit different, because he's more of a business manager, isn't he? So he wants to buy good businesses rather than just shares on the stock market, and they help those businesses, don't they, in some way?
But that is how any investor should look at investments, Stephen. And I always tell my dad that, because he looks at the stock price. My dad is one of those people that has even done a technical trading course.
Is he?
So quite
Did you
the
help him?
no, not at all. Quite a contrast. I have quite a few calls with him to convince him to get away from it, and I've been successful so far. So I've got him in a bunch of index funds. But ultimately, what I tell my dad always is, you are not, if you invest in something, you are not buying the share prices ups and downs. You are buying a real profit-making company, and you are becoming a shareholder of this company. And if you buy an index, you are buying your most successful companies in the world, and you are backing companies. Ignore what's happening over in 1 month or even a 1 year period in these companies, because sometimes companies have to go through a cycle in order to restructure and build up again. And that's true for somebody like Warren Buffett, but also true for somebody investing in an index fund.
Um, that's right. So Laurentius, I just want to put something out there that financial planners have to deal with. So a client will come along and they'll say, you know what, Steve, I want to sell out, or I want to buy this because I'm certain something's going to happen. So at the moment, this is more people wanting to sell out, probably since July, August. We've had a few people approaching us, and we do proper good training on people. It's almost brainwashing, right? Again, it feels a bit toppy, feels a bit high. I think I'll sell out now, and then I'll just have that money on the side, and when it goes down, I'll buy it back. And you kind of, as a financial planner, you are thinking, well, that's not going to work, because are you going to buy back in at the right time, or are you just going to be scared then because it's going down and you don't actually push the button? But also in your mind, you are thinking maybe,
Yeah.
I'm gonna say don't do it, but you could fall because it is going to happen at some point, because that happens regularly. We just don't know when. So if you could perhaps, for any financial planners listening to this, and for clients who are approaching them, right, we've got this nagging doubt in our mind as well, and that's okay because it's the future. But how can you help everybody
Yeah.
stick to that
Yeah. So,
rules-based
and
path?
that is normal human behavior. Don't think me or other investment managers doesn't have that urge to think, wow, the markets are currently overpriced. I think financial planners, and I've been working with you now for quite some years, and the messaging that you give to clients are very, very important in the build-up phase when things are going great. You want to tell your clients that this is what the markets does. There will be a price correction at some point. I'm not going to tell you that we're going to position ourselves to be defensive and avoid the next market crash, whatever, because you just simply can't. If the US crashes, the rest of the world's going to crash. If there's if there's a bear market in the US, there will be a bear market in all other countries most likely. Can you avoid it? Not reliably. It's very, very difficult to avoid it. The risk is, if you try to avoid a bear market, the risk is not that there's not going to be a bear market, or that the risk is that the markets are actually going to go up again. If you take the last 2 years, for example, we've had roughly 30% return over the last 2 years. That would be seen as one of the worst bear markets if we had a stock market crash of 30% now. Those investors that wanted to sell out 2 years ago, you might just as well have stood your ground, waited out. Take the COVID-19 pandemic, when we all thought the world was going to end. That's when our portfolios were down, about 23% on a global basis. How quickly was the recovery? 3 months. Take '08. That was the worst recession we've ever had, probably apart from the 70s. But the '08 dot-com bubbles, those were your worst recessions, 30% decrease, recovered within, and that was quite a long period of time, recovered within 5 years. So what I will say is, for your money, that if you have stress tested your financial plan and you are fine for a 5 year and longer time period, why even worry about it? If you have put your next house deposit in the stock markets, it's fair to say, well, let's not do it now anymore. In the first place, probably shouldn't have been in the stock market in the first place. So then I would say, get it out. You've gambled enough with your next mortgage deposit. So yeah, but it's a difficult conversation, and that's probably the most difficult part of a financial advisor, I can imagine, is sort of managing those behaviors um, with clients.
It's incredibly difficult. Because sometimes if your resilience is low that day, resilience, that's a trendy word, isn't it? right, you might just go, I'll just do it then.
Yeah, and
And it's
ultimately you would have a client, and I mean we get it. We deal with a lot of the prospects that we deal with are a lot of them have historically been very active or very passive, and some of them will tell us, well, they feel that what we are doing, staying invested, is now not the right thing. If we don't do something, they're not going to sign up with us. And you just have to stand your ground and say, well, we honestly don't think it's in your client's best interest to make irrational decisions now. It is quite difficult. Sometimes you just want to get that new client or win that client or keep that client. You have to do what you know is best for you and your clients. And that is 99.9% of the cases to just stay invested, stay in your seat, and wait it out.
This is it. So every financial planner I have ever met, all they want to do is help people, right? We want to help you. We don't want to help you screw it up, right? If you push them until they agree with you, that is not a good thing. You haven't won an argument. You've made it more likely you lose money. So it's not definite. You might be right, but it'll be a fluke.
Yeah, and it's an important point that you make. Is financial planners are not there to you're not there to enrich your clients. You are there to maintain their wealth, make sure they are well diversified, make sure that they have a successful retirement plan or a successful financial plan. And that's why you do things like stress test their financial plan, do cash flow modeling. Ultimately, it's not about making your clients rich. And I think that's a key point that distinguishes the modern financial planner to the old traditional financial planner that sold himself as an investment expert and basically probably sold a lot of endowment policies to get upfront commissions and stuff. And we still do get a lot of those traditional old school financial advisors, not as much in the UK. I have to say, my home country, South Africa, is still much more in that space where you've got financial planners selling themselves as investment experts and they're going to make your client rich. That's not your job. Your job is to keep your client's money safe and do the best possible financial planning for a successful future.
So moving on now, Laurentius, to currency and its effect on what we make in stock markets. So the US market's gone up absolutely bananas, but that hasn't been seen to investors here because of the currency exchange rate. So if you could explain about how that works and with currency exchange rates, what happens over time?
Yeah, it's interesting. So currencies is quite a difficult one to understand. And the best way I always explain it to people to understand is you have to think of any asset that you buy. And technically, it's not correct. It's the best way to understand it. Think of any asset that you buy as two assets. You have the asset itself, and then you have the currency in which that asset is denominated. So let's take an Apple stock. Apple is, let's call it £1,000. It's 1,000, but in dollars. So you've got the Apple stock and you have dollars. Apple can go up 10% and the dollar can drop 10%, and you basically have no returns. We've been very fortunate pre-2025 where the majority of our portfolio was exposed to US assets. The US dollar have done really, really well. So we've had sort of a double whammy effect with a nice tailwind where US assets grew phenomenally and also the US dollar strengthened. 2025 was the opposite. US equities, people think the US equities have underperformed the UK and the EU last year. It actually hasn't. In dollar terms, the US market is up about 19%, but the US dollar has depreciated about 9%. Our returns that we see in sterling terms is about 10% in US dollar. And that's the risk that we have with equities. Question is, should we do something about it? Short answer is not on your equity side of the portfolio, not on your growth side, because equities is what we would call a random walk. I think that's one of the few consensus that we have in the industry. You can't predict equities. It goes up and down and it mean reverts. It is just random. You can't predict it. It adds a lot of noise to your portfolio. Over the long term, it doesn't matter. On your fixed income or your defensive side of the portfolio, you are exposed to UK risks. You live in the UK, you are exposed to UK interest rates, UK inflation, your expenses is in sterling. Take out that foreign currency risk on your fixed income. It makes your portfolio much more stable and ultimately doesn't subtract or add to your return over the long term.
So, I mean, that is the job of fixed income anyway, isn't it? To dampen the spikes or falls in your portfolio as a whole. So that's difficult, isn't it? So now it is January when we're recording this, but it won't go out till February, Laurentius. But as it is the first week of January, we are going to do Laurentius's predictions for the stock market. What are you going to say?
Ah, now you're forcing
This
me
is a
to put on
trap.
an
This
active
is a
ad.
trick question.
Forcing me to put on an active ad. Hmm. Do you want a number or do you want a general projection?
General predictions. Is it going to be good, bad, or indifferent?
So I wouldn't be surprised if we have extreme volatility this year, especially with what's going on in the US. I think whether you love Donald Trump or hate Donald Trump, the one thing everybody can agree with is the possibilities of probable outcomes have widened with him in the office. So anything can happen. It makes projections so much more difficult. We know the S&P 500 is one of his success gauges, but we also know that he can be quite radical. So he could bump up the US markets or he could completely break it down. I think it's going to be extremely volatile year, but I think there are a lot of attractive companies. These large Magnificent Seven companies that everybody are so afraid of are making a lot of money in the US, but also abroad. It's only Amazon making about 70% of their revenue in the US. The rest of them are making their money in other countries, or more than 50% of their revenue in other countries. So it's highly diversified. I think we're in probably for another good run in the equity markets as the markets are trying to figure out what's going to happen, and hopefully it's true for all markets, for the UK, the EU, emerging markets, and not just the US.
Laurentius is so I didn't know that was one of his success measurements, the S&P 500. Has he said that then?
It
It's
was
like that's what he's
certainly
aiming to do.
it was certainly his success gauge in his first term, because that was the only thing that he all continued to go on about, the new records on the S&P 500. So whenever the US stock markets breaks a new high, you can be sure Donald Trump will mention it. So yeah, it is true. I think one of the big risks that we face this year is within the bond markets, especially in the US. It's never good if the president of the US have or have conflict with the head of treasury, and that I think is really bad for any country, because any currency, whether it's sterling, yen, US dollars, the legitimacy of every single currency, I feel, comes down to the legitimacy of the US treasury. And I really do hope that there's a smooth transition with Jerome Powell, or whether he's going to be reinstated or whatever. But there's a lot of risk in the market, and I don't want to go into what the probability of those risks are. And ultimately, just remember, we are investing in real profit-making businesses. Political governments adds noise to those short-term movements.
That's it, isn't it? So even last year when the tariffs were introduced, like within probably hours, but days, companies change, don't they? So the people that are running these companies, bright people, they're not just going, "Oh, well, that's happening. We're not going to do anything." They're thinking, right, how do we make money now in this new environment? What are we going to do? How are we going to react?
Yeah.
So, like I think you were mentioning earlier with Newton's laws of physics, every action has an equal and opposite reaction, doesn't it?
Exactly.
So that's what people were doing. Has volatility been a bit lower in recent years then,
A lot. So we've had
average?
2025 was an interesting year. We've had a decent start. Then the end of Q1 was with the Liberation Day of Trump announcing the new tariff policy. We had a spike in what's known as the VIX index. It's the volatility of S&P futures, and it's a way to measure the volatility of the market. And it was one of the highest spikes ever. It reached about 48%. Average is about 17%. Then it sort of toned down, and especially over the last 2 months, volatility has been around, or the VIX index has been around 14, 15. Yesterday wasn't a great market. Well, yesterday being the 7th of January wasn't a great day for the financial markets, but other than that, we've had fairly stable markets over the last couple of months.
Do you think that because people tend to worry when things are going up and down more, But I have to say, I've become completely immune to this over the years. I'm not bothered at all. Do you think there's any way we can help people get to that point, the same position you and I are in, perhaps, Laurentius, where we're not really worried about it?
Yeah. It's interesting. People do get worried when things go up and down a lot more, and that's why we tend to focus so much on volatility. If I could have a choice, I would say we have to ignore volatility completely, because that's daily movements. We should look at risks like drawdown, sequencing risk. What's the risk of going through an extended period of underperformance? Because that's your biggest risk in your investment journey, is having a long time period where I had low returns, irrespective of whether there was a market correction or not. If I haven't had optimal returns, that's the biggest risk. And if you see that that's your biggest risk, then you know sticking to equities probably reduces that risk. And then people say, well, the markets are now so volatile, I want to get out. And then the first thing that they would say is, let's go into gold. Not even going to mention Bitcoin. Gold. Gold is more volatile than emerging market equities. So it's not a safe haven. Yes, it has a negative correlation. What does that mean? It means when one asset is up, the other asset is going to go down, and it's going to detract from each other's returns. It's not a good thing necessarily. Gold is only useful for a very specific purpose over short periods of time. I'm not a huge gold fan over the long term. So what to tell people is, I would say, first of all, it starts with what you are already doing very well, is have that financial plan, stress test that financial plan, show your clients you are still on track to have a successful journey, and what actually happened or what will probably happen, we've planned for it in advance. We're not
Yeah.
going to react to it. We've already planned for it. And I think that's the most important thing. And then when these market corrections show up, pull out a bull or bear chart or whatever, and just show the clients, we knew we're going to be here, we are here. And most of the times they would think they are in a very, very dark hole. For example, last year, April, people thought that it was portfolios are down so much. And you've seen all these doom prophets on the internet saying, I wonder what all these global market cap index investors have to say for themselves now. And so, as if it's the end of the world, the markets were down 10%. We were
Which is
halfway
normal
towards,
in a year, isn't it? That's
we were
below normal.
halfway, we were halfway towards a bear market, and we all know the next bear market is a given. At some point it will happen, we just don't know when. So people do get to sort of blind themselves when markets turns negative, and you just have to be by their side and sort of show them the long term, focus on the long term, and show them where you are actually. You are not down 40% like this one media article just told you.
Those bear markets, they don't last that long anyway, do they? What is it on average? 3 years?
Yeah,
years?
it's especially in the equity side, it's much shorter. There's a strong case that bear markets last much shorter these days, because we've got the monetary intervention as well, pumping liquidity into the market. We've seen COVID pandemic 3 months. One of the longest bear markets were 08 and dot-com bubble, 4 years, 5 years at most. So that is we've actually, when we were asked what's our minimum investment horizon in our equity portfolios, we've decided as an evidence-based investment manager, let's calculate it. And we said, right, over what time period do we know clients will not lose money at a 95% certainty? And the answer was 5 years. Over 5 years, there will be 95% of the time a recovery when a bear market shows up. And the bear market's not going to show up every year. It tends to show up every 7 or 8 years or even longer.
Yeah. Just don't worry about it, I think. Anyway, so I've loved talking with you today, Laurentius. I will say to everyone, we've got some new videos explaining our investment philosophy on our website. It's under the About Us section under our investment philosophy. There's 6 of them, I think. They're all the videos of me, but also a professional person, and some proper slick stats and all that stuff too. They're about 5 or 6 minutes each. So anyone listening, go on our website, www.lucentfinancialplanning.co.uk. That's www.lucentfinancialplanning.co.uk, and watch them. That'd be great. Now, Laurentius, I really hope you get back from skiing okay, and I hope you've got some great socks. I don't know if we can do sockology today, but it would be definitely about how skiing socks make you feel awful when you fall over so much like I did.
I've got one for you, Stephen. I've got one for you. I actually came prepared for this.
And now for Sockology, where Jess and Steve review types of sock and how your socks affect your mood.
Oh yeah, baby.
Just
Your foot up.
Just to show you that I do practice what I preach. Let's see if I can get my foot up. And these are actual Vanguard socks.
Vanguard socks. They have been on the show before. They've been given out at conferences.
It's not to promote Vanguard, but it is definitely to show you that it is a promotion of one of my role models, Jack Bogle. I think he gave a massive present to the investment industry, and probably to anybody that's roaming this earth, by making index funds available to us and allowing everybody to just have successful investment products.
And on that note, rest in peace, Jack Bogle. Have a great 2026, everyone. And you, Laurentius. Hope to see you in a couple of months.
Thanks, Stephen. Likewise to the audience.
See you later, everyone. Bye.
Bye-bye.